So you wake up Monday morning, check your mail, and there's a letter from a company you've never heard of telling you they now own your mortgage. You're standing there holding your coffee thinking, wait, what? I didn't sell my house. I didn't refinance. How does a random company I've never even Googled suddenly own the biggest debt of my life? And here's the thing that's going to make your blood boil. This is happening to 12 million American homeowners right now. 12 million. That's not a typo. That's one in every four mortgages getting shuffled around between banks and servicing companies like trading cards, and nobody, I mean nobody in mainstream media is talking about it. Look, I get it. You probably came here thinking this was going to be another housing market crash video. And yeah, we're going to talk about that too, because this whole servicing transfer crisis, it's a massive red flag for what's coming. But first, I need you to understand something that's probably already happened to you or someone you know, and you didn't even realize it was a problem. If you've ever gotten a letter saying your loan has been transferred to insert company name here, congratulations, you're part of the 12 million. And if you're sitting there thinking, well, that's just normal business, right? Banks sell loans all the time. You're not wrong, but what's happening right now, this isn't normal. Hit that like button right now, because what I'm about to break down is something that should genuinely concern every single person who has a mortgage, wants a mortgage, or is related to someone who has a mortgage. And YouTube's algorithm is about as reliable as these mortgage servicers, so I need your help getting this information out. Let me hit you with some numbers that should make your stomach drop. According to data from the Mortgage Bankers Association and Inside Mortgage Finance, over 12 million mortgages have been transferred between servicing companies in the last 18 months alone. 12 million mortgages. That's roughly $2.4 trillion in loan value getting passed around. Now you're probably wondering why. Why are banks suddenly playing hot potato with mortgages? Great question. And the answer is going to connect directly to home prices, foreclosures, and the next phase of whatever the hell is happening to the housing market. Here's what's actually going on. When interest rates shot up from 3% to 7%, banks that were servicing low-rate mortgages realized something terrifying. Those loans weren't profitable anymore. See, mortgage servicing isn't free. Banks have to pay customer service reps, process payments, handle escrow accounts, deal with defaults. When rates are high, the money they make servicing cheap old mortgages doesn't cover the costs. So what do? They sell the servicing rights to someone else. Sometimes to another bank, sometimes to non-bank servicers, sometimes to companies you've literally never heard of that popped up 2 years ago with private equity funding. According to Black Knight's Mortgage Monitor, non-bank servicers now handle over 54% of all outstanding mortgages, non-banks. These aren't even traditional banks with FDIC insurance and federal oversight. These are private companies whose entire business model is extracting fees from your mortgage. Comment below if your mortgage has been transferred in the last year. I genuinely want to know how widespread this is, because the official data only tells part of the story. Now you might be thinking, okay, so my loan got transferred. Big deal. I still make the same payment to someone, right? Wrong. And this is where it gets messy. When your loan gets transferred, here's what can go wrong and is going wrong for thousands of people. Payment processing errors. Your payment goes to the old servicer. They're supposed to forward it. They don't. Suddenly you're 30 days late according to the new servicer, even though you paid on time. Escrow account disasters. Your property taxes and insurance are supposed to be paid from escrow. But during the transfer, something gets lost. Next thing you know, your county is threatening a tax lien because nobody paid your property taxes for 6 months. Customer service black holes. You call the new servicer with a question. They don't have your full file yet. They can't help you. You call the old servicer. Sorry, we don't service that loan anymore. You're stuck in purgatory. Credit score destruction. All those processing errors, they get reported to credit bureaus. Your score drops 50 points because of mistakes you didn't make. I've talked to homeowners who had their mortgages transferred 3 times in 1 year. 3 times. Imagine trying to keep track of who you're supposed to pay when and how when the company keeps changing every 4 months. One woman in Arizona told me her mortgage was transferred and the new servicer immediately claimed she was behind on payments. She had proof she'd paid. Took her 4 months and a lawyer to get it sorted. 4 months of constant stress while they threatened foreclosure. If you're feeling anxious just hearing this, that's the correct response. This system is broken and homeowners are paying the price. Subscribe right now if you want to stay ahead of what's actually happening in housing, because this story is about to get way worse before it gets better. Here's the part that should terrify policymakers, economists, and anyone who remembers 2008. This servicing crisis isn't just inconvenient for homeowners. It's a systemic risk to the entire financial system. Let me explain why. When mortgages get transferred rapidly between servicers, especially to non-bank servicers with less capital and regulatory oversight, you create a fragility in the system. These companies are handling trillions of dollars in mortgage payments, but they don't have the balance sheet strength of traditional banks. According to a report from the Urban Institute, non-bank servicers are more likely to foreclose than traditional bank servicers. Why? Because they don't have the same incentives to work with struggling borrowers. Banks care about their reputation, regulatory compliance, and long-term customer relationships. Non-bank servicers, they're optimizing for short-term profit. Here's a stat that should make your hair stand on end. During the pandemic, when foreclosure moratoriums were in place, several non-bank servicers nearly collapsed because they didn't have enough cash reserves to cover operational costs. They were days away from failing. The government had to step in with emergency liquidity programs. Now imagine what happens in the next recession. Imagine what happens when unemployment ticks up, when homeowners start missing payments, when foreclosures rise. These non-bank servicers handling 54% of all mortgages don't have the capital cushion to weather a storm. And when they fail, who picks up the pieces? The government, taxpayers. We're recreating the conditions that led to 2008, but with less oversight and more fragility, and almost nobody is talking about it. Comment what you think. Is this 2008 all over again, or is it something different? I want to hear your theories because the experts sure don't have a consensus. Let's talk about why this is really happening, because the official explanation, rates went up, servicing became unprofitable, is only half the story. Here's the other half: private equity saw an opportunity. Firms like Apollo Global Management, Fortress Investment Group, and others have poured billions into buying mortgage servicing rights. Why? Because even if individual loans aren't super profitable at scale, with millions of loans, you can make serious money from fees. Late payment fees, modification fees, escrow management fees, foreclosure fees. Every interaction with a homeowner is an opportunity to extract value. According to Bloomberg, private equity-backed servicers generated over $8 billion in fee revenue last year. $8 billion in fees charged to homeowners, many of whom didn't even know their loan had been sold. And here's the kicker: these companies are incentivized to keep you in debt longer. The longer you have a mortgage, the more fees they collect. They're not incentivized to help you pay it off early or refinance to a better rate. They want you trapped. This isn't capitalism. This is extraction. And if you're sitting there feeling like the system is rigged against regular people trying to build wealth through homeownership, you're not wrong. It is rigged, and it's getting worse. Hit that like button if you're tired of Wall Street treating your home like a profit center. Now let's connect this to the bigger housing market picture, because this servicing crisis is a leading indicator for what's coming. Here's what I'm seeing in the data that nobody wants to talk about. Foreclosure filings are up 14% year over year according to ATTOM Data Solutions. We're not at crisis levels yet, but the trend is accelerating. Mortgage delinquencies, homeowners who are 30+ days late, are ticking up, especially in states like California, Florida, and Texas. And here's the connection: when your mortgage gets transferred to a non-bank servicer with aggressive collection practices, your likelihood of ending up in foreclosure goes up. These servicers are less likely to offer loan modifications. They're quicker to file foreclosure paperwork. They're optimized for speed, not compassion. So as more mortgages get transferred, as more homeowners deal with payment processing errors and customer service nightmares, as more people fall behind because of confusion and mistakes, foreclosures are going to rise. And when foreclosures rise, inventory floods the market. And when inventory floods the market, prices drop. This is the connection between mortgage servicing transfers and home prices. It's not direct, but it's real. If you're trying to figure out whether now is a good time to buy or sell, understanding this servicing crisis is critical, because it's one of the early warning signals that the market is shifting. Subscribe if you want me to keep tracking this, because I promise you mainstream media won't cover it until it's too late. Let's talk about where this is hitting hardest, because not all markets are equal. According to CoreLogic, the states seeing the highest volume of mortgage servicing transfers are California, over 2.1 million mortgages transferred in the last 18 months. That's 1 in 3 mortgages in the state. Florida, 1.8 million transfers. And remember, Florida is already dealing with an insurance crisis, an HOA crisis, and a condo crisis. Now add servicing chaos on top. Texas, 1.4 million transfers. Texas has been a hot market, but rising property taxes and insurance costs are already squeezing homeowners. Servicing transfers add fuel to the fire. New York, 890,000 transfers, with heavy concentration in downstate areas where home values are already under pressure. If you live in one of these states, pay extra attention to your mortgage statements. Check every month, make sure payments are being applied correctly, keep records of everything. Comment your state and whether you've noticed anything weird with your mortgage lately. I'm trying to map this out in real time. Okay, so we've established this is a problem. What do you actually do about it? Step 1. Check your mortgage statement every single month. Don't assume everything is fine. Look at: is your payment being applied to principal and interest correctly? Is your escrow account balance accurate? Are your property taxes and insurance being paid on time? Step 2. Keep detailed records. If your loan gets transferred, keep every piece of paper. The transfer notice, payment confirmations, any correspondence with the old and new servicer if something goes wrong. Documentation is your only weapon. Step 3. Set up direct confirmation. Don't rely on auto pay alone. Check your county records to confirm property taxes are being paid. Check with your insurance company to confirm premiums are being paid from escrow. Step 4. Know your rights under federal law, RESPA. Servicers have to notify you at least 15 days before transferring your loan, respond to writ requests within specific timeframes, correct errors within 30 days if they violate these rules. You can file a complaint with the Consumer Financial Protection Bureau, CFPB. Step 5. Consider refinancing carefully. If you're dealing with a nightmare servicer and you have equity and decent credit, refinancing to a new loan with a reputable lender might be worth it. But run the numbers carefully. Don't trade one problem for a worse interest rate. And if you're feeling overwhelmed by all of this, that's normal. This shouldn't be your responsibility. The system should work without you having to become a mortgage expert. But until it does, protecting yourself is critical. Like this video if you found these steps helpful. So where is this all heading? Here's my prediction, and I'll be tracking this over the coming months. Short term, 6-12 months. More transfers as banks continue offloading low-rate mortgages, rising consumer complaints to CFPB, increased foreclosure filings due to servicing errors, state regulators start investigating non-bank servicers medium term, 1-2 years. Non-bank servicer failures, especially if recession hits, government intervention to stabilize servicing sector, class action lawsuits from homeowners, potential new federal regulations. But don't hold your breath, long-term 2-5 years. Consolidation in the servicing industry, stricter capital requirements for non-bank servicers, consumer protection laws strengthened, maybe technology solutions to reduce errors, hopefully. But here's the thing, the damage is already being done. Homeowners are already suffering, credit scores are already being destroyed. The question is how bad it gets before someone in power actually does something. Comment your prediction, does this get fixed before it blows up, or are we headed for another housing crisis? Let me zoom out for a second and connect this to everything else we've covered on this channel. We've talked about job losses hitting 1.17 million this year, small businesses shedding 120,000 jobs in a single month, builder confidence at multi-year lows, housing inventory rising while demand falls, Florida's insurance and condo crises, targets collapse signaling consumer weakness. The mortgage servicing crisis isn't separate from all of this. It's part of the same story. The American middle class is being squeezed from every direction. Job insecurity, rising costs, stagnant wages, housing unaffordability, and now financial institutions treating their mortgages like casino chips. Every single one of these problems feeds into the others. Job losses mean missed mortgage payments. Missed payments mean more transfers to aggressive servicers. Aggressive servicers mean more foreclosures. More foreclosures mean more inventory. More inventory means lower home prices. Lower home prices mean less consumer spending. Less consumer spending means more job losses. It's a death spiral, and we're watching it happen in real time. I don't say this to scare you, I say it so you can prepare. Because the people who survive economic downturns aren't the ones who pretend everything's fine. They're the ones who see what's coming and adjust accordingly. So here's what I need you to do. 1. Check your mortgage statement tonight, right now. Make sure everything is correct. 2. Hit that like button and subscribe, because I'll be tracking this story as it develops. 3. Comment below with your experience. Have you had your mortgage transferred? Did something go wrong? Your story matters. 4. Share this video with anyone you know who has a mortgage. Seriously, this information could save someone from a financial nightmare. The mortgage servicing crisis is real. 12 million homeowners are caught in the middle. The government isn't doing anything. The media isn't covering it. So it's up to us to spread the word and protect each other. Thanks for watching. Take care of yourselves. And remember, you're not crazy for feeling like something's wrong. Something is wrong, and recognizing that is the first step to protecting yourself. Now click another box on your screen to watch another video covering the real estate economy.